Okay, Girish Kousgi joins us, Managing Director and CEO with Canfin Home, to understand what is happening in the low-cost housing market and the HFC market and how things are evolving now that real estate demand is back. Girish, good morning. Thank you for joining us. Most of the basic data indicators are indicating that demand is back. Housing uptick has started. But has that translated into some kind of an business uptick and profit uptick also for HFCs? Because top line is great, but the market dynamics also, courtesy the kind of price benchmarks which SBI or ICICI Bank or HDFC have set out, the market is becoming brutally competitive.
Good morning, Nikunj. So if I have to look at last year, first 2 quarters, there was flight of portfolio from HFCs to banks. And that is because of many reasons. One, banks were covered under emergency services and they were all open. And all the HFCs during lockdown was closed. This impacted, in terms of customer retention. It became easy for the banks to take over. That was BT in for them. Number two, in terms of incremental business, since all the shops were closed for HFCs, we couldn't grow our disbursements. So it impacted disbursements, it impacted book retention. And number three, in terms of managing customers, all the bank home loan customers also, most of them have accounts with banks. And therefore, it was easy for banks to track their income levels during lockdown period and during COVID. And therefore, they were in a better position to manage the book and track customer income levels, whereas for HFCs, since we don't have liability, it was difficult for us. Now, all these things have changed in last 4 to 5 months' time. Now, yesterday I was watching show on your TV. I think Mr. Sanil also was very, very positive about economy activity picking up, and the GDP numbers for Q1 looks really, really encouraging. Now, if I have to talk about demand for this quarter, it is robust. Last quarter, it was very good. Actually, starting from Q4 onwards, it was very, very good. In fact, as far as Canfin is concerned, we read all-time high numbers in Q4. Q1, again, April, second wave started, which lasted for very less time. And therefore, Q1 was not that bad. It was very good compared to last year Q1. As far as this Q2 is concerned, it is very, very good. And as a company, we are hopeful of beating our best ever quarter, which was Q4 of last year's. Now, talking about the industry as such, in terms of ease of business, liquidity has eased, rates have stabilized, property prices are at its lowest, and collection efficiency because of wave 1 and wave 2 have stabilized, and it is now back to normal levels. So I don't think so there would be any impact on profitability for all the HFCs in the industry per se. However, if you talk about yield 1.5 years back, it will be higher. Now yield is lower. And if you look at cost also has come down. So we should look at margins. As long as margins are in line, there won't be any impact in profitability per se.
Great. Do you think there is a price war which has started in the HFC space, considering the rates which, let's say, PSU banks are offering, considering the kind of rates which suddenly the fintechs are offering?
If you look at market, I think market is quite large. There is space for more HFCs to operate at different yields in the market. Having said that, there was severe competition by banks, both private and PSUs, till I would say Q4. So whole of last year, there was severe competition that also forced many HFCs to drop their yields to retain the customers and also to generate new business. We also did that. If you look at our rates in Q4, it was as low as 6.75%. But from April onwards, since market stabilized and demand picked up, we also have increased our rates. So I don't think so we would again see that kind of severe competition which was there last year, probably this year or maybe in next few years to come. So I think that phase is almost over.
Walk us through what are you witnessing and experiencing for the non-salaried class, because while the salaried class, few unfortunate people may have had a issue with their jobs, but by and large the salaried class is protected. But the non-salaried class is where the COVID impact has been perhaps quite severe.
Yeah, non-salaried class, the impact was quite severe in first wave, not as much in second wave, but still, because of the impact, income levels have gone down for business class, and therefore we see lesser demand from that segment. And if you look at the composition as well, we had 70 salaried and 30 SENP. In last few quarters, that has changed on an incremental basis to about 82% salaried and balance 18% self-employed. However, this quarter, we have seen SCNP segment coming back very strongly. So in next few quarters, you will see that the mix would again be 70-30. But as of now, demand from SCNP is quite low and demand from salaried has increased significantly. So the loss from SCNP has been offset by increase in salaried. Unfortunately, for us as a company, our focus on salaried is very high, which was 70 at a portfolio level. Now it is 82 on 82 incrementally, and at portfolio it has slightly increased from 70%.
Mr. Kousgi, just an extension of the point that you just made, wanted to understand whether demand is translating into disbursements as well, and are we seeing an uptick in average ticket sizes?
I think average ticket size is more a function of strategy. If you have to talk about Canfin, earlier we were focusing on mainly affordable since last few quarters, since we had the pricing power, because we dropped rates to compete with the most big banks and big HFCs in the industry. So we had that pricing power, and therefore we started focusing on slightly bigger ticket cases, largely in salaried. And therefore, if you look at our ticket size, which was 18 lakhs, now has inched up to 20 lakhs. So it's more a function of strategy. Otherwise, if you look at ticket size per se, since the rates have come down drastically compared to what it was 2 years back, property prices have dropped, and therefore ticket size would obviously come down. If you see logically, if you look at the industry, ticket size must have come down because the rates have come down, affordability has improved, property prices have come down, and therefore the ticket size would have actually dropped.
Fair point. Could you also tell us a little bit about the geographical breakup as to where the growth really is coming in from? And if you could just draw up a parallel between tier 2 cities as well as metro cities and the trends that you're witnessing there.
I must say there is demand across. We are not that well spread in northeast and eastern part of the country. Otherwise, whether it is south, west, or north, I think the demand is quite robust. However, we are seeing increased demand in cities like Bangalore, Hyderabad, Chennai, Mumbai, and Delhi. So top cities are really contributing because we operate in the outskirts, since our ticket size is 20 lakhs and we focus right up to 1 crore in salary. And small towns are anyway robust. Small towns, irrespective of the geography, it's doing pretty well. With respect to big cities, I think top 7-8 cities are really contributing very well. But demand is across.
Okay. All right. Hi, Mr. Kousgi. This is Mubina as well joining in. Demand is across, and I think that's one of the factors that's prompting you to give an 18 to 20% guidance. You're also aiming at doubling your book in the next 3 to 4 years. Tell us how, what will be the other driving factors, and also affordable housing. I understand the total portfolio of affordable housing companies has seen an uptick. We've seen a good amount of disbursements in that segment. So if you could talk to us about, for Canfin, what will be the growth driver and how will the affordable housing theme as well contribute?
If you look at the profile of Canfin, maybe a few quarters back, I think we were largely focusing on asset quality, profitability, growth, and then liquidity. So now we've changed gears. We want to grow keeping the asset quality intact, obviously with high liquidity and best asset quality. I think slightly we've changed gears, and to that extent, we are pretty aggressive on growth. And actually, this is since last 2 years. We grew very well last year, Q3, immediately after the COVID, and Q4 was very good. Even if you look at last year, Q3 and Q4, we grew very well. So our growth engine is on, and we have accelerated our growth since over 8-9 quarters. Only thing is, because of COVID, both wave 1 and wave 2, we had to take a pause because the priorities slightly changed. But now we are again back. So in terms of growth, I think we should be able to grow by 18-20%. Going forward, there'll be growth both in disbursements as well as book with decent margins.
Okay, so your focus a few years ago was on asset quality. Now it's on growth, while obviously I'm sure maintaining asset quality. You've spoken about how your collections as well have sort of improved quite a bit. Give us a gist of what you're seeing right now. Have you seen, especially post the second wave, any major delinquencies as such, especially by retail borrowers? What's the outlook like in terms of asset quality?
If you've seen our asset quality in last 6 quarters, I'm talking about Q4 of last year when COVID started. That was in the month of March, and it was for 8 days of March, and then it continued, till now. It's almost there. So if you've seen our asset quality, I think it's very, very stable. So during very tough times, we were able to maintain asset quality, and as of last quarter, our NPAs were 0.9%. So we are pretty confident that we would be able to maintain this and further improve on this in the quarters to come. So we are pretty confident on asset quality. I think it talks about the composition of the portfolio, and we are very sure of maintaining asset quality.
Okay, well, great to hear that, Mr. Kousgi. You've got ambitious targets. So all the very best as you strive to achieve that. Thank you very much for joining us today on ET Now.
Thank you.